Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's Economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Kia ora. Welcome back to another episode of Markets, Mystics and Mayhem. Today's episode is going to be a good one. We are talking about a bit of a tough topic, but it's definitely one that's becoming sort of more central to our everyday life, but also to our life as economists. And that topic is, drumroll please, climate change.
So
it's a pretty intense topic. You know, we are hearing more and more of severe weather events, and with that comes more damage and more reconstructions and just repercussions down the line. So really today's episode is all about what's in store for the economy in a world sort of increasingly challenged by climate change. From higher costs and prices to insurance, to what that means for the housing market and even interest rates. It's really going to impact a lot of things. And with it being such a big topic, I'm not sure we're going to be able to cover everything today, but I think, where's a good place to start? Probably what we've seen here at home. We've had a few severe weather events. For me, the first thing that comes to mind is the Auckland floods. But Jared, you're actually traveling to Hawke's Bay this week, and I'm sure you spent quite a bit of time down there sort of before the cyclone, after. What have we seen? What did we see at the time? And just tell us a bit about Hawke's Bay.
Yeah, I mean, I'm heading down there again, and I've been in the Hawke's Bay region a few times over the last couple of years, and the first thing that comes to mind is the devastation following Cyclone Gabrielle. It ripped through, caused all sorts of damage, billions of dollars worth of infrastructure needs to be rebuilt. They lost about $1 billion in exports, so we lost crops. And that led to a spike in food inflation, and the region is fighting its way back. But geez, the Hawke's Bay's been through a horrible couple of years, and we've sort of been through that tough part, and they're rebuilding, which is great. But now there's another issue, right? And that is insurance costs and council rates are being lifted in order to meet these rising challenges.
Yeah, it's almost, I guess, the price impact or the inflation impact of the cyclone and the floods was kind of twofold. You first had that temporary impact with food price inflation skyrocketing to, I think, 11% year on year, but that's really normalized. Kumara prices are down 60%, so that kind of just tells you how high prices had gone during that time. But now we're seeing the more persistent impact of this, which is insurance costs, which have lifted, 25%, dwellings up 20%, on the year. So these things are becoming more persistent, and on a quarterly basis, insurance costs have lifted, 6% on average for the last 7 quarters, and that's not really typical. Usually you see a 1 quarter move and it kind of normalizes after that, but it's been more persistent.
So MJ, just to get things clear, so we saw fruit and vegetables spike, but they've normalized. Insurance costs have risen, but they haven't normalized yet. So we don't think, are they going to normalize, or is this the new norm then?
I think it's just going to take some time because these sort of flood events are becoming more and more, more frequent. And with that kind of in your horizon, you have to hedge against it, and you've seen insurance costs lift because of it.
Yeah, and you mentioned kumara prices. Don't knock kumara prices. Yes. I mean, my favourite cake place, Gatto House. The CEO told me that the price of kumara went like this and down, and so the price of those cakes obviously had to go up. Kumara being as most popular, but also eggs, sugar, all the main ingredients skyrocketed there. After the Hawke's Bay or after Cyclone Gabrielle. Those prices have come back down. So he was telling me, they're more profitable now than what they were last year. But yeah, it's the insurance costs that, are coming through now. And it's not just the cost, it's the access to insurance, which worries me.
Okay, JK, hold on. What do you mean by the access to insurance costs?
Well, yeah, what worries me is that insurance companies are reassessing their risk. There's been more frequent severe weather events, which has caught most insurance providers around the world by surprise. So if you think about the cost of insurance in New Zealand, there's about a third of it is reinsurance costs. So the fact that these insurers globally are lifting their prices because they're seeing more severe, more frequent weather events, that's feeding through to the price of our insurance. And then you look at the severe weather events we've had in NZ. Obviously we've had the cyclones and flooding, but we get droughts as well. We get earthquakes on top of that. So insurance providers, are always updating their data, and we've just seen more and more of these events, and we've seen insurance prices spike on average 24% in the last year. But the Hawke's Bay would be up here, Wellington would be up here, Auckland, parts of Auckland are up here. That's if you can get insurance. What I'm worried about is the exclusions that we're seeing in parts of the Hawke's Bay, and even getting to a point where insurance companies turn around and say, I'm sorry, but you're in a high risk area. You don't get access to insurance. We can't insure that property.
Yeah, and I think that's where the housing market's going to be very interesting, because there's a sort of maturity mismatch between the mortgage what we lend out for 30 years and then insurance, which I think is renewed sort of annually. And if your property by some database is saying that, it's going to be at risk of coastal flooding or something, and they can't get insurance, but the bank still holds that mortgage there. So it's going to be interesting to see what that means for valuations of properties.
Oh, it's going to be devastating for some. I mean, IAG put out a paper some year and a half, 2 years ago, saying that there were 20,000 New Zealand homes at risk of severe flooding, and that was prior to the cyclone and prior to the flooding. So I can only imagine that number's probably 30, 40,000. But what does that mean for us? Well, insurance going up in price, so long as the person continues to insure, that doesn't bother us, that doesn't worry us from a mortgage perspective. As soon as there's an exclusion on a property saying, we'll give you all the insurance you don't need and we won't give you the insurance that you actually do need, well, a bank is going to have to look at that as a massive risk and either ask for more equity in that home, or if they cannot get flooding insurance at all, maybe they don't get a mortgage. And if you can't get access to insurance and a mortgage, that the value of that house has to be impacted.
But then on the other hand, so you just said we have about maybe 40,000 houses that are at risk of, coastal flooding, whatever it is. But then don't we also have a housing shortage of around, we haven't run our numbers recently, but around 40,000 as well. So that's 80,000 housing shortage potentially in the next couple of years, right?
Yeah, it's a big issue. So, I joined Kiwibank in 2018 and we were looking at this. You joined in 2019, and we've been looking at climate change over this whole period. What we've been looking at is rising sea levels, but the cyclone taught us that water also comes down, right? So we're looking at it coming up. Now it's coming down. If there's an earthquake, it comes in sideways. So there's a lot more risk that we're pricing as banks, but also as insurance companies. And that's going to feed through to those 30, 40,000 homes that are at severe risk.
And I think in this instance, in this world, you'll see insurers react first. They'll start to unbundle their risk. They'll, like the exclusions you're saying, they'll give you everything, but that one sort of flood excluded. So you'll see insurers move first, and then and they'll have impact on how banks lend out as well.
Well, how far away are we from this happening, do you guys think?
It's happening now. It's happening in the Hawke's Bay. It's happening in other parts. Even following the Auckland floods, there's certain areas that are just having to pay, even more insurance.
Yeah, it'd be very region-based. Like those insurance costs that we've seen, it's largely driven by the East Coast that have seen the biggest increases in those insurance costs.
I mean, gone are the days where insurance, is priced at quite an aggregate level. It's getting smaller and smaller and smaller, and I think we're getting very close, if we're not there already, that each house will be assessed differently, by the letterbox. That's how accurate they're trying to get on their insurance, right? And they have to. They can't afford to keep getting wiped out with these massive events.
And then you're already seeing it in other countries already. Miami is a very good example in the US, where a lot of it is very low lying, and you see that the houses that are sort of higher up have a higher, appreciation and value, whereas the ones lower and closer to the, greater risk of flooding, obviously there's that difference there. So you're already seeing it happen in other countries.
Yeah, and it'll be interesting to see how the government responds to this, because, I was living in Australia when there were the Queensland floods, and, there were descriptions of biblical flooding. It was that bad. A few people struggling to get away from it. It was quite devastating. But then, as part of my tax bill, I remember paying, I think it was a 1% levy. There was a flood levy for Queensland, and the government, I think, forced the insurers to keep insuring, even though the price became inhibitive, and some people just stopped getting insurance because it was too expensive. And you also found that a lot of people just lifted their houses on stilts. So there are some solutions too.
Okay, so you just talked about a bit of government response. What about central bank response? So what we're seeing is a lot of the sort of sticky inflation we've had recently has been because of these insurance costs. And what we've been talking about right now is that, we're probably going to see these insurance costs stay quite sticky for the medium term, long term. So, I think there's quite a bit of talk out there about whether either we're going to have to start looking at inflation, excluding sort of climate-related functions, or will the central bank, have to target sort of a higher range of inflation? Currently they target 1% to 3%, but will they have to change their band?
I think that discussion will probably grow as these sort of events become more and more frequent. And again, that insurance cost that we've seen, that quarterly move, has been more persistent than previous natural hazard events. So there is a case that it's becoming, more persistent. But I think maybe now they're unlikely to touch that target band, because we've had, inflation falling back to within the band. If they had touched it earlier, it would be sort of conceding that they wouldn't be able to get inflation back under control. And they're very protective over it because they were the first to introduce inflation targeting. So I think that discussion will grow, but maybe just not.
Yeah, but it is a sort of a discussion that it's worth sort of thinking about, because, if the central bank did have to sort of accept a higher sort of range of inflation, what does that mean for interest rates as well? It means that we're also in a sort of more high interest rate environment.
Well, yeah, it's interesting, right? I think, we sort of unbundle that a little bit and go, well, right here, right now, the central bank, their number one goal is to get inflation to 2%. That seems to be a bit of a magical number globally, right? Only the RBA came out with 2.5 just to be different. But, 2% seems to be this number. That number, I think, will have to be discussed, in the next few years. And climate change is going to be an issue for both of you for the rest of your career. So, how the price of climate change comes through, it's clearly going to be an inflationary period as, we reprice the risk of all these events, but also as we substitute away from, say, fossil fuels onto, more sustainable methods of doing things, that's going to be inflationary as well. But you're right here, right now, the Reserve Bank's targeting 2, they're going to get us back there. It's a discussion maybe for late in 25, 26, if they think about the band. For me, I think the easy thing is just to exclude what you don't like. I mean, it's what we do as economists, right? I don't like that number. I don't like that number. That number doesn't help. This doesn't back what I want to say. So you just cut all that out.
So kind of like how we look at sort of core inflation, which is like inflation stripping out the volatile price movements like fuel. It's pretty much that, but for maybe insurance costs. What you're saying is probably the...
And climate-related inflation. Just, maybe there's a CPI X climate basket. Maybe we should come up with one.
Yeah, sounds like our next task then.
So, climate change is a massive, massive topic. And we each think of different things when we think about climate change. NJ, what's the first thing that comes to mind for you?
Mine would be, what's just top of mind is just the insurance costs that come with it. The hikes in insurance premiums that we've seen over the last year, I think that will soon act as a sort of signal to future buyers, and that'll be more difficult to get insurance in certain areas because of risk of coastal flooding or other natural disaster events. So that you might see the sort of insurance retreat, and that'll impact valuations of certain regions, and that's going to happen. That's going to have an impact on the housing market and different regional property markets.
If you can't get insurance, you can't get a mortgage for some of these places.
Yeah.
So that to me worries me. But this massive cost inflation from insurance is huge, and it's ongoing.
Yeah.
What about you, Sabrina? What's the first thing that comes to your mind?
Probably just the real devastation from the events themselves, and maybe the immediate costs to businesses or to households. In the Hawke's Bay, how many $1 billion of rebuilds were there?
Yeah, about 13 billion, I think.
Yeah, those are households or businesses, losing a lot of income from the crops destroyed, from the rebuild they had to do. It's quite, we talk a lot about the soon-to-be soon-to-be issues that we have to deal with insurance, but we can't forget there's also that immediate impact.
Which is massive, absolutely massive. Like you say, the Hawke's Bay region devastated. It's not just weather events either. New Zealand, it's earthquakes as well. And the Christchurch earthquake was, a $40 billion event, right? And these insurance companies have been hit by it. So when I think of that, you've got the devastation of the events themselves, and you've got repricing of insurance and what that means for mortgages. What does that mean for our economies? Obviously, we need to make ourselves more resilient to these events, which is inflationary, because you've got to spend more money on infrastructure. What does it mean from a central banking point of view? You're going to have to look through these events the best you can. Spike in inflation and what happens around these events. But if it's going to last potentially the rest of our lives as something that's just ongoing, central banks are going to have a good hard look at their inflation targets and either exclude climate-related costs or lift their mandated inflation target. And that's just the start. We will come back with more on climate change.
Well, that's all we've got time for today. But like I sort of mentioned at the beginning, we've only really just started to scratch the surface. For me and MJ, this is really going to be the cornerstone pillar of our careers, and really seeing the issue sort of evolve, not just for insurance, but what it's going to mean for the housing market, inflation, and even interest rates. But that's all we have time for today. Thanks for listening. Make sure to tap that like or subscribe or follow button, and we'll see you next week.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.